Okay, here we go with part 2 of chapter 14, money banking and the Federal Reserve System. So it's kind of the banking piece, entitled for part 2, How Does the Banking System Create Money? In part 1, among other things, we talked about why is our money, right, the currency we have in our mouth, worth something, and because the government tells us it is, and we believe it. With the second part being the important part. Well, Um, I'm willing to bet that if everybody in the United States truly understood this following section, or this part 2, that belief might diminish quite a bit, because there's that's belief, and now that basically what I'm going to be telling you is you need to believe in magic. Okay, so here we go. All right. So to start with, when we have our banking system, is effectively a fractional reserve banking system. So to understand what that means, we need to understand what reserves are, and then why it's fractional. Okay, so what does that mean? Well, you put money in the bank. Let's say you put $1,000 in the bank. So unless you put it, you get a safe deposit box and literally put your money in that safe deposit box, such that that you're basically renting that space from the bank to keep it safe. The money that you put in the bank, right, in a normal savings or checking account, doesn't sit around in the bank. The way that the bank makes money, right, since, although there might be some fees for checking accounts and things like that, for the most part, the bank doesn't make much money, or really money, holding on to your money. They make money by using your money, right? So basically, you put in $1,000, and they don't have to leave that $1,000 in the bank. They can do stuff with it, and what we're going to focus on here is lend money out with it, and earn interest. Right? So, what are reserves? Well, reserves are the fraction of the deposit that they actually do hold on to. So if you put $1,000 in the bank and they lend out 200, or let's say 800 of it, and they keep 200, the $200 is the reserve, right? So it's an asset to the bank, but it's also a liability to the bank because they owe it to you. Okay, so the reserves are created when deposits are made, and then reserves are reduced. Right, that cash asset side is turned into a loan. Right, if they lend part of that money out. So banks can't lend it all out, as we'll talk about. So that's why it's called a fractional reserve. They have to keep a fraction. They can't lend it all out. They got to keep some of it there. And what they do with that, either they literally keep cash in the vault, or predominantly deposits at the Federal Reserve. Okay. Now, although this isn't an exact number, but more or less at this moment in history, the U.S. banking system, commercial banking system, has a required reserves of 10%, which is called the required reserve ratio. Right? What fraction, right? What percentage of the money that people put in as deposits do they have to hold on to, either in the vault or at the Fed? As the example I gave, where they lent out 800 and kept 200, right? They didn't have to keep all 200, so they keep above the 10%. It's called excess reserves, right? And they can lend that out and do stuff with it, but sometimes they keep a little bit of a buffer. Okay. So, to the title of this part 2, banks can create money. How do banks literally, like magic, create money? Well, by doing what I was just describing, by using the excess reserves, right, the amount that they don't have to hold on to of the money you put in the bank, to make loans. Okay, and the Khan Academy goes over, well, they go over, it's kind of funny, I have a link to a video basically doing the same kind of thing that I'm now doing with these slides. But anyway, you can go watch about what's in M1, M2, which was already in part 1 of our thing, but also talking about how banks make money, and what we're about to go through. Let's do an example. Let's see the magic, the theoretical magic in work. So 10% required reserve requirement. Remember that. So let's take a hypothetical person. Shannon, right? Shannon has $1,000 of currency. To keep it all really simple, let's assume that that is the only um, money that exists, right? There's nobody has any checking accounts, right? No one has anything else. No one else has other currency. So the M1, right, from part one, the M1 part one lecture slides, the M1 money supply is literally that $1,000 of currency. Okay. But she doesn't want to hold on to it, right? She doesn't need to use it right now. So let's say she puts it into the Bank of MM. I think I got those initials. So she puts that $1,000 in the Bank of MM, and she still has it, right? She's got her debit card. She can still buy stuff with that. But now it's in the form of a checking account. Okay, so what's the money supply now? Well, the money supply is still $1,000. It's just not currency anymore. The currency's sitting in the vault. Um, but it is in the form, as far as the money supply, of the checking account that she can write checks on or use a debit card to access. Okay, so no money is created yet, right? So it's still $1,000. Now here comes the magic, right? So let's say that the Bank of MM loans money to Brian, right? Because remember, they don't have to hold on to that $1,000. They can lend some of it out. So let's say they lend out the maximum they could. So what is the maximum of that $1,000 that Bank of MM can loan out? Well, with a 10% reserve requirement, it's 90% of it, or $900. So again, what they can lend out, right? The amount of deposits they have times 1 minus the reserve requirement. So 1,000 times 0.9, $900. Okay, now you might not have seen the sleight of hand yet. How much is the money supply now? Right? So assuming they lend out that maximum. How much is the money supply now? Well, the magic has happened. The money supply has grown. The money supply is no longer $1,000. The money supply is now $1,900. Shannon's $1,000 checking account balance and Brian's currency that he just borrowed from the bank. Magic. Bank of MM just created, or the banking system in total, but in this case, the Bank of MM created $900 of new money. Now, some of you might be literally sitting there like, you're watching a magic show. It's like, well, but yeah, that's how it works. Fractional reserve banking system has a lot of analogies to kind of like a Ponzi scheme, right? But there's kind of all kinds of regulations around it, blah, 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 but that's how the banking system works. So let's take it one step further, right? So let's imagine, right, that Brian now says, okay, before I'm going to start a business maybe, but in the meantime, right, before I kind of do anything with that loan, I'm going to make my own, get my own checking account balance in the Bank of MM so I can use it rather than carry around the $900 in cash, right? So, Bank of MM, from the money that they just created, right, can now lend out more money. How much money can they lend out? Well, again, 90% 90% of that 900 or $810. Let's round it for simplicity. And let's assume that they lend out $800 to Chris. What's the money supply now? Well, I think you might have the magic or understand how the magic works at this point. The original $1,000 deposit that Shannon started with currency and put in the bank, and then that they lent to Brian, and then Brian put back in the bank, and then that they lent 800 of it to Chris, and now the money supply is $2,700 and counting, right? So at least theoretically, that process, right? Chris could take it 800 and put it in the Bank of MM or a different bank, and it could just keep going and going and going, right? That's how the banking system can create money. And again, as I mentioned earlier, I think if everybody in the United States understood that this is how the banking system works, that belief in your money in the bank might be diminished pretty damn significantly. But anyway, onward. So that's theoretically how much it could make, right? Or if that process kept going, right? So let's say that they kept to the theoretical maximum. So the 810, let's say lent out 810 instead of 800. So that could be then turned into blah, 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 blah. And it can keep going and going and going and basically become a mathematical ratio that means that basically isn't necessarily completely intuitive, right? But the theoretical maximum that the banking system create is, well, the money multiplier. Or I guess I should say the money multiplier could either be the theoretical maximum money multiplier, which is for every dollar, right, divided by the reserve requirement, or however many dollars we're talking about, how much could it be multiplied? Well, every dollar can be multiplied by the $1 divided by the reserve requirement, which if the reserve requirement, as we've been assuming here, is 10%, how much is the maximum theoretical money multiplier? How much could theoretically the banking system create? Well, 1 divided by 0.1, 10. If the money multiplier was 20%, then it would be 1 over 0.2, or theoretical maximum money multiplier would be 5. Right? So in our example, right, there's not $1 that we started with. There was the original $1,000 of currency that went into the bank. So how much could that be turned into with the 10% reserve requirement? So the money multiplier is 10, right? 10,000 bucks. Okay, so that's the theoretical maximum money multiplier. But in the real world, right, it is nowhere near that theoretical maximum. And in fact, in recent last couple of decades, has shrunk to be much, 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 much smaller than that. Now the book, right, from whatever year this was, 2018, I believe, basically says money multiplier in quote unquote normal times 1.6, right? Instead of, even though the reserve requirement is approximately that 10%, instead of it being truly multiplied into 10 times that, it's more like 1.6 times that, right? Under normal circumstances. So why doesn't the maximum amount of multiplying happen, right? The maximum amount of money creation? Well, part of it is banks might not lend it all out. There's a lot of other complexities, but some kind of the most straightforward kind of things that hopefully make sense, right? Banks might not lend it all out. So that 10 money multiplier with a reserve requirement of 10% assumes that they lend out all of it, right? But instead of lending out the 900 out of the 1,000, they only lend out 800 out of the 1,000. That keeps happening each time. Then that would already reduce it to 5. Right? And there's all kinds of other reasons why they might not lend it all out, because this isn't the only kind of regulation that they have. They also have capital requirements that we'll talk about later in another section. But yeah, so they might not lend it all out, and customers might not keep it. They might keep some currency. They might not put it all in the bank, right? If you remember the M1 money supply, what is it, roughly 35-40% currency, the rest checking accounts. So that also diminishes, right, the money supply. So Shannon might not have originally put the $1,000. She might have kept 100 or kept 200, right? And sort of the less possible multiplication happening, and each step along the way there could be less multiplication happening. Now, quote unquote normal times 1.6. During the Great Recession, right, 2007, 2009, real world multiplier fell much closer to 1, i.e. not a lot of multiplication happening with the amount of theoretical money that could be created with this process. And the Federal Reserve has basically an estimate of what this money multiplier is, which very honestly, I'm not sure why, but they have decided to stop creating this estimate. But here's what it was, at least. So when's the last time they updated this? So the end of, well, very recently, December 4th, 2019. So notice that for all kinds of reasons that beyond what we're going to delve into to go over, the actual money multiplier has been shrinking for quite a while. Um, Partially because the banking system has become much more complex, and partially because commercial banks don't hold nearly as much money now as people's um, um, liquid assets now as they did even in 1980s. But what we are going to focus on a little bit is this, right, where it just dropped like a stone in the middle of this great area, right, the Great Recession. So why did the money multiplier go from um, an estimate of 1.6, right, September 10th, 2008, to within very, very short period of time, less than 1? Well, basically what happened was the Federal Reserve did a lot of expansionary monetary policy, which should really be the discussion and make more sense when we go over chapter 15 on monetary policy. But basically, they bought up a bunch of bonds and all different types of bonds, and that put more money into banks. And the banks didn't lend it all out. So the excess reserves in the banking system, right, with that money, that liquidity, that the quantitative easing, all these terms that we'll talk about a bit in chapter 15, there was a ton more money, and they lent out far less of it. It used to be that excess reserves was relatively small, right? So so if you look at this, so excess reserves of depository institutions, i.e., how much excess reserves in the banking system. So look, based on the scale that happened after the recession, right, you can see that it just ballooned from looks like nothing, right? So right before, like it ballooned. What was it at? It was like 1.8 billion dollars. It sounds like money, right? But within a few months, it was $796 billion, right? So multiplied by many, many thousands of percents. And then over the next 4 years or 6 years of expansionary monetary policy, it went up to like $2.7 trillion. Then we're getting away from the Great Recession, so they started kind of like going the other way, which again we'll talk more about in chapter 15. And so excess reserves started shrinking, shrinking, shrinking. But lo and behold, we are in the beginnings as I make this recording of the coronavirus pandemic. Federal Reserve expansionary monetary policy that is again shooting that number that was starting to come back down, nowhere near quote unquote what used to be normal levels. But shooting it back up, and who knows how high it's going to go. So a little summary of what we just looked at on that slide, right? So it grew from like 1.5, 1.6 billion, right, to right before the recession to 2.7 trillion, right, between 2008 and 2014, starting to shrink, right? Basically, like half of that went away in ways that we'll talk about again, right? Notice again, really key, billions to trillions, right? 1,000 times as much, well, 2,000 times as much almost, excess reserves, right? From the low that it started to the peak. About a half of that was shrunk, right, over the next 5 years. But again, as we saw, COVID-19 expansionary monetary policy growing it again, backed up to 1.9 trillion as of March. By the time I talk about this again, either this summer if I teach a class or the fall of 2020, but you might be listening to this in the fall of 2020, this number will no longer make sense. I might have to re-record this. And that is part 2. How the banking system creates or can create money. not so happening so significantly as it used to. And then part three will be a little bit of an overview of banking regulation, some of the other things that the bank has to pay attention to besides the reserve requirement, and a little bit of the structure of the Federal Reserve.